This is Kyle Boston, First Coast Financial Group, and this is your market update for August 9th, 2021. Really what I want to touch on in this video today is based on a lot of conversations that I've had with, our current clients and with other professionals in the business. And that is really all revolving around one question. That question is, how is the market still hovering around all-time highs despite these two huge concerns that we have? And those two concerns are COVID and their inflation. Really, the short answer to that is, it's the market believes that really we've got both these situations under control. That's still to be decided, but ultimately the market is responding that way. And, like I said in the last video, there's a lot of money still sitting on the sidelines. There's a lot of money that's still sitting in money market accounts. So really what I want to do today is try to break down those two concerns, really the way we're looking at them, and try to see how much of a concern they really are, and throw a couple of viewpoints in here. So to start, I want to start by breaking down the inflation story, because the media is eating it up. Every time we have inflation talk or anything kicking in, it's very high. We're in the middle of reopening our economy still, and hopefully we stay that way. But, the Federal Reserve has really gotten the spotlight on all the inflation talk. So you've probably heard of the Fed or the Federal Reserve or Jerome Powell. And those phrases are thrown around so much. I think if you're somebody that just doesn't watch financial news every single day, that may not be top of mind to you. So real quick, I want to break it down for those of us that are not incredibly familiar, or just for some trivia purposes. Fiscal policy is essentially maintained and run by Congress and the president for the most part. And monetary policy, or the money policy, is dictated by the Federal Reserve ultimately. So, in other words, the Fed. And right now, Jerome Powell is kind of the guy who does most of the talking for the Fed and is kind of the spotlight for them, so to speak. So, the question is, why so much government spending? Because everyone I talk to said, hey, the government is creating this inflation problem. They're throwing money at people. They're putting so much money out there that there's a lot of money and not enough supply to meet all this demand. And that's, in really basic terms, what creates this high level of inflation that we're looking at. So the question is, why? Why are we continuing to do that? And really, I think it can be summed up in the fact that a little bit of inflation, controlled inflation, is actually aspired to be attained by the government or the Federal Reserve. A little bit, or controlled levels of inflation, which the Fed, and I'll get to this in a little bit, has earmarked at about 2% on an annual basis moving forward, can be healthy. And so I've got an interesting piece here. This is BlackRock. They've got a software that we use sometimes that's got some AI modeling called Aladdin. And it helps us break down different scenarios in the market and look at some of the AI modeling, kind of backed into how it's performed historically. Obviously, this is not concrete or guaranteed or bulletproof by any means, but it's a good barometer and good for example's sake here for this. So I'll show it. But really, if inflation expectations rise generally by 1% in a year, we can look for equities to have a good year. So stocks, ETFs or mutual funds that contain stock holdings, equity holdings, typically look for that, and they like it, because the point is, if you have a demand for products, you're going to have more sales, you'll have more revenue and more growth in turn. So equities are actually a pretty good place to be in to take advantage of moderate, healthy inflation year over year. The other thing that I'll point to is this GDP chart, this gross domestic product. Really, in a simple way, this is a measure of economic output for a country. That's the basic unit of measure, so to speak, is by GDP. And so with this chart, it kind of shows the annual, I think this one's broken down quarterly, the quarterly GDP breakdown growth quarter over quarter for us. So you can see that although we've had some really high levels of inflation, we've also seen pretty unprecedented levels of growth along with that. And that's exactly what we're looking for coming out of this recession, the COVID recession. So looking at and expanding on the question, why so much government spending? Why do we have so much money just circulating? It's created a lot of money on the sidelines as well. Really, that can be kind of broken down to a good example, at least, is let's look at our targeted inflation over the last several years. Okay, we've been targeting 2% for a while. And this chart shows you we've been right at or right below 2% for quite some time. So pre-COVID, we were not hitting our 2% target of inflation. That can lead to some frustration if you're the policymakers, because you're saying, hey, I want controlled levels of growth and I want them at about 2% in general terms. And if that doesn't pan out, that may signal some warnings. Why don't we have enough growth? Why aren't we have enough sales? Demand is not where we want it to be. So essentially a good example for maybe some justification. If really I'm trying to get into the minds of policymakers here. A good example is the Great Depression. We've all heard a lot about it. Not many of us have lived through it, hardly any at this point. But during the Great Depression, a huge problem was actually deflation. Deflation is the opposite of inflation. So deflation are falling asset or values for multiple things. So basically, prices are falling across the board when you're dealing with deflation. And this also has a snowball effect. So with deflation, think about it this way. The tables are turned. There is a whole lot of supply. There's not a whole lot of demand. So in turn, you've got less sales across the board, less growth. People don't have the money to buy these things after a while. And with that, what does that do? That means that you've got less jobs and then in turn, less money. Correction there. That also means there's less liquidity. So that means that people in general have less money in their wallets, in their bank accounts, to go out and buy new goods, to invest, etc. So that is actually a really, really scary problem. And the Great Depression, and look at this. This chart is awesome. I mean, it breaks down deflation moving right before the Great Depression and then how long it takes. Look at how long it takes for us to get back to, a level of growth or a healthy level of inflation. That is a much scarier problem than moderate inflation, especially to policymakers. And I think that over time, this country has learned from some of its mistakes. The Great Depression, I think the policymakers really took a reactionary stance. It took a lot for us to get out of that period of history. And really, if I'm the Fed, if I'm policymakers, I'm thinking, wow, I do not want our people to go through that again, ever. So we'll run the risk of having above target levels of inflation in exchange of not having to deal with deflation and all the horrors that come along with that problem. And in the Fed statement, the Federal Reserve press release, these come out incrementally from time to time. And I've got a copy of the most recent one here. So I'm just going to read a portion of this and kind of break it down really quickly. So this is the Federal Reserve press release, and I'll try to leave a link in this, depending on where you're watching this video, to the whole statement. But this was released 2 p.m. July 28th of 2021. And I'm skipping ahead a little bit, and I'm just going to read a portion of this. But in their words, with progress on vaccinations and strong policy support, indicators of economic activity and employment have continued to strengthen. The sectors most adversely affected by the pandemic have shown improvement, but have not yet fully recovered. Inflation has risen, largely reflecting transitory factors. Transitory meaning not permanent. Overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and the flow of credit to U.S. households and businesses. The path of the economy continues to depend on the course of the virus. Progress on vaccinations will likely continue to reduce the effects of the public health crisis on the economy, but risks to the economic outlook remain. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. With inflation having run persistently below this longer run goal, the committee will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and long-term inflation expectations remain well anchored at 2%. The committee expects to maintain an accommodative stance of monetary policy until these outcomes are achieved. So that's a whole lot of words, but really what they're saying is that the economy is showing some improvement. The progress of the virus, the course of the virus, is going to be a crucial factor in our overall recovery. Vaccination is going to be a key part of that. And they're targeting at slightly above 2% inflation for the foreseeable future to help get us caught back up to our original goal of 2%, which we weren't hitting in the past anyway. And the committee is going to maintain a very supportive and accommodative monetary policy until all those objectives will be met. So overall, it's saying, hey, we're on the way back. Inflation is not where we want it to be. We understand that in the meantime, it may be higher than we expect, but that's not necessarily a bad thing. And that's essentially their viewpoint. And, the media loves to hype this stuff up and really to scare us on some of these, on some angles. But I like to look at the Fed statements and the press releases to see, from the horse's mouth, what's really going on. Where are they at in their own minds? COVID, I'm not going to spend a whole lot of time on COVID. I'll just kind of cut right to it. There's a lot of unknowns still, but vaccinations, and you can look at this right here. This is going to be, I think these are, as of yesterday, the vaccination numbers. And you can see, I think we're fully vaccinated. We're up over 50%. I mean, that is a tremendous increase from even my last video that I posted where we were nowhere near these numbers. And they're growing very fast every single day. And from all the research coming out, it's not conclusive, but the point is that it's very, very likely that the vaccine is going to be our biggest defense and also our biggest weapon moving forward against COVID. So essentially maintaining a status of cautiously optimistic, because I think that's where the market is. We hover around all-time highs. We break all-time highs with some good news or good economic data. And as long as these concerns remain under control, I think we can look for some more of the same. But again, we're living in a very volatile world. So maintaining your discipline and staying well-positioned is going to be key during times like this. So if you've got any questions about what I discussed today or how your portfolio is set up for these concerns and maybe the best case, worst case scenarios moving forward, feel free to reach out to us. You can contact us. The best place to go to contact us, you can schedule an appointment right there. It's on our website, firstcoastfinancialgroup.com. We got our phone number on there. Just feel free. You can give us a call. You can book an appointment. Come in and see us. I encourage it. But thank you so much for watching. Again, this is Kyle Boston with First Coast Financial Group. Hope you have a great day.